Bitcoin remains in the $40,000 zone, and the macroeconomic situation shows signs of an economic growth standstill. Inflation continues to lead the way. Let's get started. In this weekly chart of Bitcoin, we can see in the week of February 28th to March 6th an inverted hammer candlestick. This candlestick is located in the lower part of the trend, which represents great volatility and the possibility of a downtrend reversal. However, the candlestick created a shooting star candlestick, which represents that we're still in a phase of indecision in the market. This week, starting on March 14th, an upward movement has been carried out, which places us in the $40,000 zone and draws a nearly full-bodied green candlestick so far. With the deployed averages, we can see that the price seems to want to move towards the $45,000 zone. That zone doesn't only represent the higher part of the macro range in which the price has been trapped over the last few months, but also the resistance over which the 20 and 50 period moving averages are about to enter. In addition, we can see that the 20 period moving average is crossing the 50 period moving average downwards. In a technical analysis, this is a bearish sign. In the daily timeframe charts, we can see on the 16th a strong upward movement where we can observe with more clarity the macro range in which the price has been moving over the last few months. Right now, the price is located at the relevant intermediary level of $40,000 to $41,000. This candlestick on the 16th of March was engulfing in nature and accompanied by a considerably strong volume input. But we can't lose our focus. In this chart, we can see that the price is leaning on this symmetrical triangle pattern. This price is shrinking. This pattern reveals that the chances of the price finally breaking upwards or downwards is 50-50. It will depend on the moment in which we see a major volume entry. The moving averages, as we can see in this chart, are grouping up, and we're still seeing the order which indicates a downtrend: 200, 100, 50 and 20. But there's a clear short-term movement. The price has crossed the 20 and 50 moving averages, and now we need to wait and see if it continues to consolidate that zone closing above those averages. From then, the price could go on to test the higher part of the symmetric triangle. In other words, that resistance which also coincides with 0.61 Fibonacci extension. On the contrary, if that zone is lost, we'd see a pullback to return to the lower part of the symmetric triangle, where additionally 0.78 Fibonacci is found at around $37,800. If we wanted to see an upward movement, first the price would have to reach the 100 period moving average, which today is located at $42,500. In this case, it could go on to test the $45,000 zone, where there's an important resistance, the higher part of the symmetric triangle, and 0.61 Fibonacci. But if we take a look at the red candlesticks closing below the 20 and 50 period moving averages and the volume input, we'd move on to the lower part of the symmetric triangle, which coincides with the important support zone and 0.78 Fibonacci. Moving on to traditional markets, the SP 500 index shows us clear downtrend that began at the end of 2021. As we can see, lower highs have been forming, but from January 25th to March 8th, a clear bullish divergence had formed on the RSI. That divergence already warned us that there was a possibility of an upward movement, although let's not forget that this boost has also been caused by a series of fundamental elements, and more importantly, in a technical analysis, we're only speaking of probabilities. And despite the upward movement we have witnessed over the last few days, we cannot yet consider it a trend reversal. It's important to remember that to confirm a trend reversal, the structure of the chart would have to change. In this case, to reverse the downtrend, we would have to see candles closing above that trend line. The Ukraine war, the price increase, and the decisions made by central banks are causing a feeling of fear in the market. This is shown in the Fear and Greed Index. In the on-chain analysis, we can see that from March 7th, around 68,000 Bitcoins have been withdrawn. This could indicate Bitcoin owners' intentions of keeping their assets in cold wallets. The trend seems to be very clear. There's less and less Bitcoins in exchanges, meaning there's less Bitcoins available to be exchanged. A good sign, given if there's less availability, the price could be pushed upwards. If we move on to the fundamental analysis, the most important news of the week is the rise in interest rates by the Federal Reserve, a measure which continues to contain inflation. The price index is shooting up as a consequence, mainly due to the increase in energy prices. And to contain it, the Federal Reserve will carry out a series of increases in interest rates up until the end of the year. The aim? To cause the price of money, in other words, the financing, to become more expensive, and therefore the price of goods and services is contained. In fact, the Federal Reserve announced the forecast over the coming months in a document called Dot Plot. The institution foresees that the gross domestic product will grow by just 2.8% in 2022. A reduction in the forecast, as just 3 months ago the Fed had a forecast that it would grow by 4% in 2022. This is a negative side of raising interest rates. They serve to contain inflation, but also affect economic growth, since it is more expensive for companies and individuals to finance themselves, and when rates are raised, consumption tends to fall. In addition, the Fed anticipates that it will reduce its balance, a balance that is expanding enormously since the start of the pandemic to inject liquidity into the markets. Specifically, it has acquired a multitude of government bonds and mortgage bonds, but now they're gradually getting rid of them, something that the European Central Bank will also do. Cutting off the stimulus tap will put a brake on the economic growth. Although the president of the Fed, Jerome Powell, warned that these measures will be subject to the risks that occur in the macroeconomy. In short, it looks like over the coming months, we will have two leading roles in the macroeconomic scene: uncertainty in the markets and inflation.